I just want to welcome everybody to our student workshop that we have, of course, invited our wonderful alumni to as well. Investing Made Simple, a practical guide for adult students. My name is Meg Frantz, and I'm the Director of Alumni and Donor Engagement. I'm also a 2020 TESU graduate, having earned my Master of Public Service Leadership degree. I am so pleased to welcome my fellow graduate and financial guru, Edwin Calzaretta. Professional in the financial services industry since 2021, Eddie strives to deliver the highest level of personalized advice, guidance, and planning for a select group of clients. Prior to joining the Rose Group, he began his career as an aircraft technician and maintenance manager. Eddie has always been fascinated with wealth management and cultivating relationships, and began at Morgan Stanley as an analyst with the firm. His areas of focus include financial planning, wealth management, asset management, retirement planning, life insurance, annuities, 529 plans, and long-term care insurance. Eddie currently holds his Series 7, 66, and SIE licenses, as well as the Financial Planning Specialist designation. Born and raised here in New Jersey, Eddie currently resides in New York State and received his bachelor's degree in applied science and technology from Thomas Edison State University. He later went on to complete his master's degree in management and doctorate in business administration, all here at TESU. Active in his community, Eddie is involved in numerous clubs and associations, including the Professional Aviation Maintenance Association, as well as the Northern New Jersey Region Porsche Club of America. When away from the office, Eddie enjoys outdoor activities such as fishing, boating, surfing, snowboarding, and skiing, as well as bowling and spending time with his family. He's also a musician and has played the guitar and drums for more than 25 years.
Excellent. Well, thank you for having me, and thank you everybody for joining the fundamentals of investing. So when we think about investing, all right, investing is the path that most millionaires, I think, take to get to higher wealth, right? Essentially, you're making your hard-earned dollars work harder for you. It might seem a little complex from a high level, but I think when you break it down into individual pieces, it actually gets a little bit more digestible. So whether you're building wealth in a taxable portfolio, meaning you're buying and selling securities or assets that you have access to that capital now without incurring any kind of tax penalties, or you're building for retirement assets, right? In other words, you're dedicating money or assets and you purchase them now, but you're committing them specifically for later on in life when you retire, or both. When you are purchasing small quantities of bigger things, you begin to own these assets, right? As opposed to borrowing or renting or using credit or not buying them. You're owning these assets and you're essentially making your dollars work harder for you, right? In its most basic form, investing is simply taking ownership of something, right? Dedicating your dollars to become an owner in another type of asset. But essentially, by doing these things now, investing now, you're taking steps today towards building a more beautiful tomorrow, right? And when we think about who can be an investor, the answer is everyone, right? So long that you have your deductibles covered, right? Your expenses. You want to make sure that you have enough money set aside to live and subsidize your lifestyle, right? And when it comes to age, well, we're going to get into this in much more detail when we go through the rest of the presentation, but your biggest asset is time, right? We all know time doesn't go backwards, so the sooner you can start investing, the better. And this is because what you're doing is you're utilizing the benefits of compounding growth. Now, kind of a fun fact, I think it's pretty interesting, is not everybody knows this, but $1 that you save when you're 20 years old actually equates to $88 in retirement money. Now, if you wait 10 years, $1 when you're 30 years old actually reduces to $23 in retirement. It's still significant, but you can see that there's a big impact on how much, you know, a dollar equates to if you start a little bit later. $1 when you're 40 equates to $7, and every dollar you save when you're 50 years old, when you retire, is actually worth $3. So that's why starting sooner or earlier speaks volumes and pays dividends, pun intended there. So one of the most valuable assets is what? It's time. But it's truly never too late to start investing and building a portfolio. That in conjunction with having a solid foundation and the comprehensive awareness of investing, you're on your way to building something great. With that, Meg, you gave me a beautiful introduction, but I'll give a brief, very brief recap on my background. I'm a financial advisor with Morgan Stanley, and worked in the airlines prior to being an advisor. I have my degrees from Thomas Edison, all three of them, and being an advisor has been quite the journey. It's great. I'm sure everybody on the call tonight has very different and diverse backgrounds relative to their professions and their personal lives. As a financial advisor, I service close to 500 relationships, 500 families, individuals. Actually, is equating to somewhere near $1 billion in assets under management, of course, alongside my team as well. Our team takes a very comprehensive approach to wealth management. And there's a reason why I'm pointing this out, is because whether you're a financial advisor or you're just starting out investing, the foundation is the same. Taking a comprehensive approach that culminates two key elements. It's financial planning and investment management. Those two things have to work in concert with one another in order to make sure that you are properly positioned financially, right? We have to understand what your requirements are for the ride, right? And through a wealth creation lens. And I'm here to break that down and conceptually and give you a couple elements to think about it, to contemplate. And those elements are, and you'll hear me repeat this through the whole presentation, your needs for liquidity, your appetite for risk and volatility in the portfolio, and your investment time horizon. So most people will join these seminars. I've given so many of them, but a host of different reasons. You are dissatisfied with your investment returns and you wonder if you can do better. Maybe you left investing up to a significant other, a family member, or maybe you don't think you possess the know-how or the knowledge to make confident decisions. Whatever it is, we're going to break it down. I think by the time this presentation is over, you'll have some good food for thought and be able to make a little bit more educated and confident decisions. So we're going to jump to the next slide and dive right into what we're going to be covering today. So our agenda is we're going to be covering the 4 major asset classes of investing, the basic principles to consider when you're investing, importance of proper asset allocation and diversification as a risk mitigation strategy. And then at the end, we'll tie it all together and we'll provide an opportunity for some questions as well. Let's begin. Major asset classes. What is an asset class, right? An asset class is a group of similar types of investments, and there's 4 of them. So we have cash or cash alternatives. We have fixed income, also known as bonds, and we have equities. Everybody knows equities, stocks, Google, Amazon, Apple, and number 4 is the alternative asset class. Now, each of these asset classes will behave differently in different market scenarios, right? And they are also associated with different levels of risk and different expected returns. Now, with that in mind, each asset class plays a very different and important role in your overall portfolio. So we'll dive into each one of these asset classes and break it down a little bit more thoroughly here. So cash or cash alternatives, this is the portion of a portfolio that provides liquidity and capital preservation. So they're very short-term debt obligations that can be easily converted into cash. It might include products like CDs or certificate of deposit, money market accounts or money market funds, U.S. Treasury bills, and they typically provide a higher yield than what you would get in your average savings account. Now, the thing to remember with cash or cash alternatives is although they provide the highest level of safety in a portfolio, when we're thinking from risk to capital among all the asset classes, their returns may not keep up with inflation over a longer period of time, which is where the other asset classes come in. Fixed income. Fixed income or bonds, I think of this as an IOU, right? So it's often used in a portfolio to provide stable income. So when a bond is purchased, a buyer is essentially lending money to the issuer, right? Which can be a company, could be a government, could be a government agency, municipality, a financial institution, the list goes on. But the entity that's issuing the bond is expected to pay interest, and at scheduled intervals, usually it's semi-annual or twice a year, in addition to the principal amount when the bond matures. Now, you can have bonds that are 1 year and they go all the way out to 40 years. Depends on where the yield curves are, and again, what your need for liquidity, your appetite for risk, and what your investment time horizon. Now, bonds typically are less risky than stocks in looking at history, with a lower amount of return, right? You can expect lower returns for that stability. Therefore, bonds serve the function of providing income into a portfolio. However, they do tend to be more sensitive to interest rates. And if we're looking at the markets today, I think the chatter on Wall Street is, are we cutting rates? What is inflation going to do with tariffs and all these different things? When interest rates rise, the bonds that you hold, the value will actually drop, because now a new investor looking for a new bond can go out and buy a bond that's paying a higher interest rate. So as long as you hold a bond to maturity and the credit quality of that company is good, the issuer of the bond agrees to pay you back your principal amount, plus the interest that you would have collected along the way of the life of the bond. Equities. Everybody knows equities, stock market. Having equities or owning a stock is you're having an ownership in an actual company, right? So the value of these shares, they'll fluctuate over time, of course. Now, because there's more risk associated with stocks historically, they provide the highest level of return in a portfolio, right? Now, over a shorter period of time, stocks are potentially risky, depending on the stock that you decide to purchase or invest in, but they are the growth element of a portfolio. So you have your fixed income or bonds, that's your income. You have your stocks, is typically used for growth, or what we call capital appreciation. Now, if we look at the different types of stocks, there's generally three, right? We have dividend or income stocks, we have value stocks, and we have growth, right? Dividend stocks are securities that pay regular dividends. Usually a company will pay out dividends quarterly if they're going to pay a dividend. They don't always have to. But the reason why they pay a dividend is they're more established companies that don't need to reinvest their earnings or their profits for growth, right? They've already gone past that growth stage. Now, value stocks are securities that have fallen out of favor in the market, and they're typically priced lower than their peers. So the objective of buying a value stock is you're trying to capitalize on an inefficient marketplace, right? You want to buy at a discount, but over a longer period of time, right, the asset will catch up to its peers and you end up making some money on it, right? You make capital appreciation. And then obviously growth, they're securities where their earnings are expected to be higher than the average market, right? These companies are devoting most of their revenue, the money that they make, towards expansion. So they typically will not pay a dividend, or if they do, it'll be very low. Last, we have alternatives, right? Alternative investments. Now, this is really a newer asset class over the last several years, and it's really starting to gain some traction. But what an alternative is, as the name implies, it's an asset that falls outside of stocks or bonds, right? With that in mind, it's not uncommon to see a particular alternative asset move in the opposite direction of a particular market, like the stock market or the bonds, because it has a low or a negative correlation. So, alternatives would not be a publicly traded company, right? Or it'd be more privately held companies, private placements. You can have private credit, private equity, all different types of alternative asset classes within alternatives. And because these these types of assets are not publicly traded, they tend to be a little bit more illiquid, which hence is the fact that they're really serve the purpose in a portfolio for a longer term investor because it brings higher diversification and attempts to generate higher returns. So selecting an asset class. How do we know which ones to invest? Now that we've covered the four major asset classes, the most important, one of the paramount factors of investing is making sure that you're selecting the proper asset allocation, meaning how much to have to stocks, how much should we have to fixed income, how much do we need in cash or cash alternatives or liquidity, right? And how much to the alternative asset class. To answer this question, we revert back to those three main principles. What's your need for liquidity, your appetite for risk, and of course your investment time horizon. And that's what this slide is showing, kind of a recap that, cash is for typically capital preservation or now money. Fixed income, yes, capital preservation, but also gives you a stable stream of income to the portfolio. The equities is capital appreciation with a hint of income if you're playing in the dividend stock space, and alternatives, again, capital appreciation, but giving you that overall diversification into the portfolio. Okay, let's talk about the basic tenets of investing or some principles. And actually, we'll also touch on some common mistakes, especially that I see quite frequently with not only new investors, savvy investors as well, right? Time matters. The earlier that you can start investing, the more opportunity you have for your investments to grow. And what I mean by that is what I referred to earlier is compounding, right? What compounding is when your investments make money and you reinvest those earnings, your money is making more money. So we call that earnings on earnings, right? And if we take a look at just a basic example on the lower left-hand side of the screen, right? Alex invests $3,000 per year between the ages of 30 and 70. By the time he's 70, he invested $123,000 in invested capital. Now, if you assume an 8% return a year, that $123,000 would have grown to almost $500,000, $495,000, $143 at age 70. That's compounding, right? Let's take that same kind of scenario, same growth. We have Jordan, who waits until 40, invests not $3,000, but $4,000 a year between the ages of 40 and 70, right? At 70, Jordan would have invested $124,000. So actually a little bit higher than Alex. Assuming the same rate of return of 8%, Jordan would have $339,206 at the age of 70. So you can see that the compounding over a longer period of time obviously allows you to experience more growth. And now, last we have Taylor. Taylor starts investing at 50, stops at 70, invests $6,000 a year. At age 70, Taylor would have invested $126,000. Again, 8% return. Taylor would have at 70, $239,956. That's more than $500,000 less than what Alex started at. So again, the earlier you can start, the better, because you're allowing the compounding in time. And quite frankly, it allows you to not worry so much and make emotional decisions. And that's actually our next slide, is how easy it is to let emotions get in the way. So when it comes to investing, again, even the most savvy investors fall prey to bias and emotional trades. Movements in the market make you uncomfortable. I mean, I watch the markets every day, and I'm kind of callous to it now, but even still, it makes me emotional when you see the markets drop. Nobody likes to see red on the screen, but developing a plan and having the discipline to stick to that plan and stay the course of action can help you avoid common mistakes like buying and selling at the wrong time, buying high and selling low. We don't want to do that. Timing the market is very flawed. Large swings up in the market more often than not tend to coincide with large downswings too, through tough times in the market. And this is why, again, time is one of your biggest assets. You can see actually from 1990 to 2022, the average return of the S&P 500 was 10.6%. And that means, 1990, the market might be up 30%. 1991, the market might be down 4%. 1995, the market might be up 15%. If you take all of those years and average together since 1990, 10.6% is your annual return. From 1990 to 2022, if you missed only 15 days out of that whole time frame, your return actually drops almost 3.5% just by missing 15 days. So that's why being regimented, staying invested, and dollar cost averaging, or maybe putting in whatever you can put away after your expenses at scheduled intervals, dollar cost averaging helps you essentially beat the market, right, and experience higher returns. So the S&P 500 certainly has grown over a longer period of time, despite many negative events. If you actually zoom in on a shorter time period, you can see it's up and down. Zoom out, the trajectory is up, and that's for the S&P 500. That's also, you'll see, for the small cap stocks, even fixed income, right? Long-term government bonds, even inflation. Inflation has gone up since since 1926, when that was the global financial crisis. It's time is your friend. Don't make emotional trades. Have a plan, stick to it. And I think one of a quote that has always resonated with me is, again, even the most seasoned money managers will unquestionably agree to one thing. It's not about timing the market. It's about your time in the market, right? Okay, asset allocation and diversification. So your asset allocation is arguably one of the most important determinations of risk and investment outcomes. So by building a proper asset allocation and combining different asset classes in your portfolio with varying proportions, studies actually show that your asset allocation is more important than the actual securities that you pick to have in your portfolio. And this graph actually shows it here. 91% of investment returns are as a result of how you allocate your assets. 5% contributes to is as a result of the securities or the stocks or the bonds or the individual positions that you put into your portfolio. 2% market timing. Nobody's, if anybody tells you they can time the market, probably not somebody that you want to be listening to run your portfolio. And establishing an effective asset allocation, as we discussed earlier, every asset class has a distinct characteristic and purpose in your portfolio, and it performs differently in response to different market changes. So as you see this chart, right, on the left-hand side on the bottom, the lower risk typically coincides with lower returns, right? As we move to the right, higher risk, higher return. This is why it's important to understand and implement a diligent and comprehensive process to determine how much you should have to each asset class. It varies from person to person. It varies from taxable assets to retirement assets, right? If you are putting money away and you can't touch that money until you retire 20, 30, 40 years down the road, it might be okay to take on a little bit of additional risk to allow the market to go up and down and fluctuate and take advantage of the compounding and take advantage of market swings in between. And this slide just kind of speaks to the different types of goals, right? Capital preservation, you can see, obviously we want to have a much higher degree of fixed income in the portfolio, so we see less fluctuation, right? Or we see opportunistic growth. it shows 72% to equities. It's just a baseline. I have clients that are 80% in equities and alternatives, and I have clients that are like to be aggressive. They only like 50% because even though they want that element of growth and volatility and compounding, they're not as comfortable with that volatility in the portfolio. So decide on value stocks gives you a little bit of, or dividend stocks will give you a more tamed and conservative approach to the equities sleeve of the portfolio. So with that said, diversification, this is showing that diversification actually, one, decreases your risk in the portfolio and volatility, but two, it actually increases returns, right? Because you can have concentrated stock. If stock in just Apple goes up, you make money. Apple goes down, it hurts. Spreading out risk, where if you have a particular sector of the equities or the fixed income market that goes down, you have branches throughout different sectors and different asset classes to soften the blow, right? But over a longer period of time, increases returns. And again, liquidity needs, appetite for risk and volatility, and your investment time horizon. The last slide, let's bring it all together, excuse me. Okay, so what do we know? Diversification, or different asset classes via diversification, each asset class serves a different purpose in your portfolio. Time is money, right? Starting to invest as early as you can allows for compounding interest. Successful investing, we know now, requires patience, it requires fortitude, and it's not about timing the market, right? It's about time in the market. I love saying that, and I'll say it till the cows come home. And asset allocation, one of the most important determinants of risk and exposures, and quite frankly, investment outcomes. Diversification, we know, provides better risk-adjusted returns. And that's what I do here at Morgan Stanley along with my team. So I wanted to thank everybody for joining, listening in. I hope you're able to take away a couple nuggets of helpful insights. And of course, I'm always available and happy to connect with anybody one-on-one if you want to have some more tailored advice, but to your specific situation. With that, Meg, I will open it up to questions. It's an open mic policy. As she said, I've been a musician for quite some time, and I'll sing for you.
Thank you, Eddie. That would be a bonus for sure. I love it. So just a couple of questions have come in through our various means of communicating. And one of the question is there a certain amount that we should be contributing for our retirement assets?
Great question. So when we think about how much we can contribute to retirement assets, again, it goes back to those principles, right? Your needs for liquidity, your appetite for risk, and your investment time horizon. So you want to obviously make sure that you are stocking enough money on the side to pay all of your expenses. Any money that you have left over, all right, it might not be a bad idea, whether it's $100 a month, whether it's $200, it could be $50 a month. Starting at any level speaks dividends. Like I was saying, $1 at 30 years old, or at 20 years old equates to $88 in retirement. Whatever you can put away, so long that you have enough money to live and sustain your lifestyle, and also that you don't have any debt. If you have credit card debt, knock that out, right? Any extreme liabilities, you want to eliminate the debt side of the balance sheet as much as possible before you actually start contributing to retirement or taxable accounts as well.
Great. We had a question about crypto. Is that something that you or your firm covers? And do any of these principles apply?
So crypto, yes. I can say on my team and our practice, right now we do not include crypto in the allocations because it's so volatile, right? Bitcoin is up and down, and quite frankly, it's still very new. Even though crypto has been around for the better part of quite a few years. It's new and it's not going anywhere, but we have ETFs that give you exposure right now. Morgan Stanley, as well as I believe all the other firms, Goldman Sachs, JP Morgan, they don't offer crypto exposure in terms of being able to actually buy coins or crypto on the open market. It's usually by a secondary investment like an ETF. But again, it's super volatile. Can be considered an alternative asset class or a hedge. But I wish I'd have put money into it when it was cheap. But hindsight's 2020. You got to be careful with crypto. And again, I wouldn't recommend putting all of your money into crypto, even if you believe in that it's going to be the next digital monetization. You want to have your hand in a little bit of everything.
Thank you. I was just going to ask that if diversification across a variety of different, such as you already presented in your presentation, the 5 different buckets of different kinds of asset classes and cash and things like that. And so we just to clarify, when you're talking about equities, you are talking about stocks, the stock market, correct?
Correct.
Great.
Yeah, stock
Okay.
market, all the Magnificent Seven.
Yeah, there we go.
And
Yes, exactly. Let's see. Are there any specific questions that we should be, or what are things we should consider if we're seeking out a financial planning, a financial professional such as yourself?
Yeah, that's a great question. Different advisors and different brokers, whatever term you want to use, they have different practices. I don't consider myself a broker because I don't like to broker trades. That sounds kind of like an old term. When you're vetting and choosing or deciding on who you want to work with as a financial professional, you want them to be diligent, right? You want them to listen to what your goals are, right? And tailor their solutions around what you're actually looking for. And also note that when you tell a financial professional something, make them repeat it back to you so they understand, to make sure that they're listening. You have to be with somebody who's transparent and somebody who cares, without question, because if somebody who cares and understands what you need is the advisor that is going to kind of take you to the promised land. I've actually had plenty of clients that are looking for certain strategies or certain investment philosophies that don't go with the way that I and my team invest. If it's too aggressive, maybe they're looking for a high level of or concentrated stock positions. The way that they run things or the way that their practices has to align with what you're looking for. Transparency, somebody who listens, somebody who cares, and somebody who, quite frankly, works with a firm that has reputable resources.
Great. Thank you. Those are excellent tips when communicating with professionals like yourself. If you have any general questions for me here at the university, I'm always happy to help answer those as well. We are so grateful for your time and expertise, Eddie. What a great presentation and what a great primer on the land of investing. And I appreciate your candor about crypto as well, because I was very curious about that too. So thank you to the participant that asked that question.
Of course. It's always an honor to be able to speak to fellow alumni and students. And as always, Thomas Edison has been great to me. So anyway, I can
Thank
participate.
you. So grateful to have you as part of the community, and all of you, we're grateful to have you as part of our community.